Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for January 18th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, Principal Data Scientist, and Dean Croak, Principal Industry Analyst. Good morning, guys.
Morning.
Good morning.
I am hunkered down in the bunker due to the winter storm. Unable to traverse the wintry landscape of Northeast Ohio.
Yeah. You guys got walloped, Ken. Get a lot of snow.
Yeah, I'd say I took a yardstick out, I think about 18 inches where it wasn't drifting, 18 to 20, and then like where it drifted in my front yard was over 4 feet, so like up to my waist. So
Wow.
Double snow day.
Yeah.
Lovely. So for those new to the program, we're not normally in our basements, but this is a bit of a extenuating circumstance. But we meet here every week on Tuesday at 10 a.m. Eastern to talk about trends in the freight market, what we're seeing, answer some questions, but most importantly, to answer your questions live. So if you have any thoughts, questions, comments, whether you're on Facebook, YouTube, or LinkedIn, please feel free to drop them in the section below. We have marketing folks that will pass them on to us. So with that, I am going to hop right into our key points of the week. So spot rates did bump up a little bit, which is, I'd say, pretty abnormal for January. Dean will cover that in his update. Spoiler alert, we did see some volume surging. As we mentioned before, Winter Storm Izzy, hiking rates. Again, I mean, it impacted a large swath of the Northeast and New England, which was already hit by the last couple storms. So that's just something to keep in mind. There were a lot of interstate closures that limited truck traffic over the weekend. December imports up, 106 ships waiting, 18 days to unload. Again, we talked about how the new year wasn't going to magically assuage the port crisis, or the port backlog, whatever you want to call it, in Southern California, and that's panning out. And I think this is an interesting one. I'll let Dean cover in more detail. We talked a lot about the vaccine in the Supreme Court and all that stuff domestically, but this is an interesting tidbit about drivers being turned back at the Canadian border if they are not vaccinated. Much like Novak Djokovic, I think Dean had a bit of a W there that he'll talk about in a minute, seeing Novak board that plane back, turning away from his homeland. So with that, I'll turn it over to Dean and get us through the market update. Dean?
It's one of the bright spots on the weekend. Good to see the right outcome there. So let's dive into the market update this week. Let's start with our load board activity in dry van. As Ken mentioned, load volumes increased on our load boards last week, almost back to about the same level of load posts in the lead up to Christmas, which is interesting. Load post volumes still about 140% higher than week 3 last year, which is kind of interesting. There's lots of volatility in the market right now. Fewer carrier posts, though, over the same time frame. So what we're seeing this week is the load-to-truck ratio dropped about 19% to 9.72. In the refrigerated sector, much the same. Load post volume surged up about 17%, almost back to pre-Christmas levels. More carriers did return to the market last week, and even though there was a 28% week-over-week increase in equipment posts, capacity is still about 12% lower than this time last year as measured by equipment posts. As a result, the load-to-truck ratio also decreased. It dropped by about 34% to 21.63 loads per truck. And in flatbed, some interesting statistics. Volumes did drop about 20% week over week, still about 90% higher than this time last year, but more than double this time in 2018 for context. That's an extraordinary statistic, I think, considering the 2018 bull market was primarily driven by incredible demand for flatbeds. That was driven by rebuilding efforts resulting from hurricanes in late 17, a surging industrial economy, oil market rallying, and changes in the tax code. So lots of things changed the 2018 market, but we were a long way ahead of where we were in 2018 in the flatbed sector, given that that was mainly a flatbed market. Carrier equipment posts about 3% lower than the same week last year, so the flatbed load-to-truck ratio remained unchanged at 86.95. So diving into the market condition index, having a look across the country, as Ken mentioned, weather was the big story this week, particularly east of the Mississippi. Even the Midwest got hit pretty hard. Up in Minnesota with some cold temps. Some of the stats this morning, 11 states were hit with double-digit snowfalls. Wind hit about 70 miles an hour up here in New England. Lots of damage. What we did see last week in the broker and carrier market, lots of load post volumes and freight moving ahead of the storm. Spot rates did surge ahead of Winter Storm Izzy arriving in the Northeast. As Ken mentioned, PennDOT shut down a lot of in-states, which is really, really interesting. They did it so far in advance. It's forced a lot of carriers to delay Monday load appointments. There were lots of carriers had appointments Monday, got to stay home on Sunday. But the effects of that will reverberate throughout the northeast this week. We'll know more on next week's show what sort of rate volatility we did see. We did see some impact, particularly out of the large Pittsburgh market. Load post volumes were up 22% last week. Outbound rates were up 11 cents a mile to an average of $3.01. And after being relatively flat for 5 months, spot rates for loads from Pittsburgh to Boston increased 43 cents a mile last week ahead of the storm. Average is about $4.53 a mile right now. Loads from Pittsburgh to south to Atlanta, also the same thing. Rates increased 68 cents a mile to $3.50 before the storm pushed in. And just north in Erie, PA, spot rates increased by 31 cents a mile to $3.37, following a 21% increase in volume. Further south in Charleston, also impacted by the cold weather and snow and ice. Spot market volumes increased by 43% week over week. That pushed outbound spot rates up 9 cents a mile to $3.06, excluding fuel. Having a look at the refrigerated market condition index, lots of cold temps in the Great Plains and upper Midwest. What we typically see this time of the year, reefer capacity tightens as dry freight shippers look to reefer carriers to keep their freight from freezing. Spot rates in those two regions increased 12 cents a mile last week to an average of $3.13. Rates in that region are now up 34 cents a mile since winter officially began the week before Christmas. Capacity is still really tight out of Twin Falls. Twin Falls to Los Angeles, rates have been climbing consistently since last July, now up $1.48 over that time frame. Spot rates on this 905-mile run are averaging $3.40 this week. On the East Coast in Elizabeth, New Jersey, spot rates reversed their recent downward trend and increased by 25 cents a mile to $3.25 for loads to Lakeland, Florida. And on DAT's busiest reefer lane, which is Atlanta to Orlando, spot rates are up slightly by 6 cents a mile to $4.27. Northbound rates out of Orlando back to Atlanta, it's another busy lane, continue to climb as loadings of winter produce continue to volumes grow in southern Florida. Spot rates northbound are now averaging $2.35. That's up 70 cents a mile since the 12-month low last September. Wrapping up the market condition index look with flatbed, volumes continue to trend downwards. Loads moved on DAT's network last week were down 4% week over week and are now down 11% in the last month. Even though volumes are down sequentially, capacity remains tight in some markets, especially on the Gulf Coast this week. Spot rates increased 2 cents a mile. Average outbound rate is $2.85. That's reversing the downward trend from the prior week. Biggest market for flatbeds in DAT's network, capacity was tight in Houston. Load post volumes increased by 11%, but spot rates stayed a little bit much the same as the week before, up about 1 cent per mile at $2.81. Capacity was tight in Miami for flatbed carriers last week. Spot rates were up 34 cents a mile to $2.80. With the same observed on the southern border flatbed market in El Paso, even as far west as Tucson. Outbound spot rates in those two southern border markets increased 26 cents a mile, averaging $2.04. Loads from El Paso to Los Angeles are paying slightly higher at $2.22, excluding fuel. And wrapping up our market update with a look at the year-over-year spot rates in dry van capacity. Dry van capacity reversed course last week, tightened as Ken started the show off with. Rates were up 4 cents a mile, regaining the losses from the prior week. The last time spot rates increased in the month of January was way back in 2018 when the market was just heating up. The national average dry van spot rate ended last week at $2.78, excluding fuel. That's 63 cents a mile higher than the same week last year and 83 cents a mile higher than week 3 in 2018. In the refrigerated market, spot rates did something also they haven't done for a long time. It's mainly 2018 was the last time we saw this sort of increase. Only moved up 1 cent per mile last week. The average is still over $3 at $3.16 per mile. Last week's national average reefer spot rate is 82 cents a mile higher than the same period last year and 79 cents a mile higher than week 3 in 2018. And wrapping up with our year-over-year look at flatbed spot rates after dropping by 3 cents a mile the week prior. Last week's national average spot rate increased by the same amount to end the week at $2.67, excluding fuel. The national average is now 45 cents a mile higher compared to the same period last year, and an amazing 61 cents a mile higher than the same week in 2018 when the flatbed rate rally was just getting started. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. So that's it. I'll throw to Ned for the short-term forecasts.
Hello, everybody. We have a couple of pretty interesting short-term forecasts for this week, mostly as a result of these unexpected, in my opinion, increases in rates. We're going to begin with the dry van forecast. In blue, you can see the market rates observed by DAT, and then off to the right in green, you can see the ratecast forecast, expecting rates to stay more or less at the current level, with a small drop off as we head into the early part of February. This is quite a difference from the prior forecast, which was expecting rates to drop, but the sudden uptick, largely due to weather conditions, has definitely taken that fire out of the ratecast drop. In terms of the short term, in red, you can see it's expecting rates to continue to head up and to the right. I think it's way too bullish, foreseeing about 15 cents of increase over the next month. Unless the weather is very, very unusual, I don't expect that to happen. And in gold and silver, the blended forecasts are a mixture of the short-term and the ratecast forecast in different amounts and in different ways. And they both expect something on the order of 5 cents of increase over the next monthly period. Moving on to Reefer. Once again, in blue, you can see the market rate observed by DAT. And then off to the right, you can see our forecast. In green, you can see the ratecast forecast is expecting normal seasonal patterns to assert themselves despite the recent uptick and rate rally, dropping by about 10 cents over the next month. The short-term forecast is more bullish, but not quite as bullish as it is in dry van, expecting about a 5-cent increase over the next period. And the blended forecast in gold and silver, which again are mixtures of the two forecasts in different amounts and in different ways, are leaning a little more towards the ratecast side, dropping by about 5 cents over the next period. Finally, moving into the flatbed market. Once more, in blue, we have the market rates observed by DAT, and here we have a great deal of model agreement. We're expecting in all our forecasts things to stay pretty stable, maybe with a little bit of upside, maybe more on the flat end. Ratecast in green is expecting things to remain flat. In red, our short term is expecting a gain of about 4 or 5 cents over the next month, and the two blended forecasts are leaning more towards the short term model, with gains of about 3 or 4 cents. And that is it for our forecast, and it's time to move on to the IQ question of the week. And we already had some kind of questions about this that I saw in the chat, but it'll be interesting. Which is, anyway, our IQ question of the week is, how has the LTL sector responded to the e-commerce boom as a result of the pandemic?
So just to kind of tee this up, we're going to have a bit of a inadvertent theme over the next few weeks of less than truckload topics. So we have a guest coming on in a couple of weeks to talk about expedite and sprinter van, cargo van type freight. We wanted to kick that off. We've just been getting a ton of questions about LTL. So for this one, we're going to talk traditional LTL. So the hub and spoke, palletized freight, rated with SAR late and tariffs and all that kind of stuff. So we can think about LTL as this entire kind of total universe of less than truckload, like literally less than truckload. But for the next couple of weeks, and we'll remind you guys of this, we're going to talk about partials differently than true LTL. True LTL being Saia, Old Dominion, FedEx Freight. Who am I missing? Schneider has an LTL division.
Yep, DAT and Freight.
Yeah, those are the regionals, the big nationals. So we're talking about that kind of LTL. So really to kick this off, I think one of the things to consider when talking about LTL is how that freight, once it's aggregated into full truckload. So what does an LTL carrier actually do? They pick up your pallets, right? You don't have enough to fill up a whole truckload. So they might pick up a few pallets here, or they might pick up a few pallets from someone else. They bring those into their terminal. They aggregate them up. They might ship that off in some truckloads to a hub that gets resorted. A bunch of forklift operations happen. It gets shot off to other spokes where it gets broken down, and then you have P&D. So there's really like 3 distinct pieces of LTL. You have pickup. You have kind of the terminal side operations. You have the over the road or over the rail type stuff, which is both conveniently abbreviated OTR. And then you have the breakdown and then the delivery, right? So you have P&D, that's sort of bulking, and then the line haul, if you will.
So
that line haul piece has been very much exposed to the current market conditions. P&D is handled by company drivers, Sure, they've had trouble maybe getting company drivers in especially early in the pandemic with the driving schools being closed, but we haven't heard a ton of problems with having the P&D work getting covered. Sure, I think warehouse work has been a little bit difficult, finding people, forklift operators and whatnot. But these companies are greatly exposed on the over the road, especially how they've chosen to strategically align themselves with external capacity. So if you're an LTL carrier that's leveraged the rail and purchased transportation over the road heavily, you're probably having a pretty rough time. Where would that show up? Service degradation, right? You might be getting economy service for priority prices, surcharges, things like that. And we all know the situation with the rail. But with that, I wanted to turn it over to Dean to maybe talk through some of these accessorials and surcharges you're seeing on the LTL side and why, from a carrier perspective, they're sort of being forced to do that.
Yeah, I think that we had Glenn on from the company escapes me talking about LTL a few months ago, and they were talking about Pitt, Ohio. That's right. And something that I took away from that was the average consignment size, and it was kind of this morphing of less than obviously full truckload into the LTL space. And he was talking about how difficult it was for carriers to charge for what I'll call ugly freight, which is freight that's not palletized, it's not boxed freight, you can't stack on top of it. It's really difficult to handle freight that comes with a very high surcharge. In his example, it was a piece of steel that spanned 4 dock doors. And I think that's the thing that they've been dealing with is instead of all of this freight moving in normal traditional full truckloads, there's been a sort of a leaking of full truckload freight into the LTL market because of the tight capacity and inability of truckloads to run at full capacity. A lot of that volume has moved into that market, and we're seeing some of the accessorial charges being added to those smaller shipments as a result of both the increased weight, but then also the additional handling costs and the different type of trucks that you need to handle that freight. So I just know anecdotally here in New England, we're seeing a lot more box trucks with lift gates because a lot of that freight that you would normally see in the LTL market that can be handled by one driver is now having to be handled by 2 drivers with a lift gate on the back of a box truck.
Right. I think too, right? Trailer utilization is a huge problem in any of the fixed networks at the moment. So whether you're full truckload, less than truckload, you're intermodal dealing with containers, same deal, right? As trailers. Yeah. You are going to pay a price if you're detaining that container or that trailer longer than kind of what the norm would be. So a lot of those surcharges have went through the roof.
Yeah, we heard last week that shippers are sort of have a view that some of that demand for truckload capacity has been inflated because of the fact there's more trucks moving, but they're not as full. So I think there's been, shippers have both been looking for capacity in both markets, both FTL and LTL, to try and get freight moved. But of course, that comes at a premium, whether it's the spot rate or the hourly detention charges or the final mile piece that requires a different type of equipment. And then you've got cross-docking before it even gets onto that truck.
Right. Ned, we had talked about, not to put you on the spot, we had talked about developing a kind of a national LTL forecast. Is there any update on that?
Well, the model that we're using for doing LTL has been performing reasonably well at the individual load level, but as far as aggregating it, it's been something that I would want a little more. I'm trying to think of the right way to say this, but like LTL is so different. It's one of the challenges, for example, with a flatbed model is that each individual flatbed load is very, very different. And when you have the data that's aggregated at the level that we have at DAT, sometimes it can be difficult to break apart the individual components and understand why one load moves for this amount and why a different load moves for that amount. For LTL, you have a similar kind of a situation, but it's definitely something that's on our radar.
Cool.
If that makes sense.
Yeah, and I know we just on the shipper side of the house, shipper and 3PL side of the house, we just moved our LTL model benchmark up to a quarterly update, and we're moving that to monthly eventually. So if you want to batch benchmark a lot of shipments, as Ned said, you can reach out and we can spin a bunch of shipments through that model and compare you to a market assessment of what you should be paying. And again, thinking in terms of like percentages or variances to market with LTL is a lot more helpful than kind of comparing price per hundredweight on rolls of paper versus computer parts.
Yeah.
Ned, do you want to get us to the question questions in the chat?
Our listener questions. Yes, certainly. We had a very early question come in from Corey Barron. Are you going to talk about Canadian load capacity?
We've been getting a lot of questions in general about Canada. So we have kind of
Right.
another Roper portfolio company. Was it LoadLink up in Canada?
Yep.
Getting a lot of questions about that. A lot of questions about our Canadian rates data. I don't know. I'll turn over to Dean about total Canadian load capacity. I don't have a ton of.
Yeah, we don't have a lot of visibility into that, Ken. In fact, I've got a call into LoadLink to talk about that to see if we get someone on the show, because there's a view that from the Canadian Trucking Alliance that about 10 to 15% of capacity will be affected by the southbound vaccine mandate that's being implemented with Canadian carriers trying to enter the US. I think that comes in on the 22nd. So I think that's going to be very topical. But generally, we don't have a lot of visibility into where capacity stands in the Canadian market just yet. But if we could take that question on notice, Corey, we can get back to you with a more intelligent answer next week.
Or have someone from LoadLink on the show. I have a couple contacts over there.
Yeah.
Roy Ambrose asks, do you have any outlook for straight trucks? It seems the rates are low. And they have a clarification. I'm sorry, I should mention that I'm driving a 26-foot dry box and I'm in Iowa.
So straight trucks have a lot of experience pricing straight trucks coming from the expedited industry.
Right.
Like I said, we'll have a guest on in a couple of weeks that'll be able to talk through some more of this. Straight trucks are a paradox because in a normal market, you're making, if you're lucky, 75% of what a full truckload makes. But in 100% of cases, you bought the truck and the trailer because it's bolted on. Right. So, straight trucks are much more expensive than a tractor trailer because you have to buy the box and the truck, right? You can't just buy the power unit. Now, there's exceptions to that. Like if you're hauling freight for the government, like dromedary loads off of the DOD boards or pharmaceuticals, right? The temperature control stuff from there. A lot of those loads, the box has to be fixed to the power unit in some form or fashion, and it's just not feasible to do with a articulating box. You'd be better off using a straight truck. There's also some tax dynamics at play, right? You're limited to, I think, 3,500, 5,000 pounds or something if you don't have the tag axle. But once you put the tag axle on, you're subject to the federal excise tax, which is considerable. So a lot of folks downgraded their rigs by taking the tag axle off, and they can't haul very much. So you're hauling a lot of air, which again doesn't help with your rate. Your traditional straight truck industries would be the automakers in the Midwest. Again, if it's a refrigerated straight truck, he says it's a dry box. Yeah, dry box. Yeah, I mean, you're going to be sort of limited in, especially if it's I should have honestly taken a huge step back and delineated between your typical rider trucks, right, that are just day cabs versus your full kind of Class 8 sleeper straight trucks, which I'm assuming he's talking about with a 26-foot box. But again, the market's just so fragmented that you really sort of need to find your niche. And I'm not sure in Iowa that there's a ton of line down situations happening. Right, that was the best load you could possibly get. One of the big three automakers or a tier one auto supplier had a line down situation. They needed to get more than a Sprinter van could handle, or more than a couple Sprinter vans can handle, load up a box truck, load up a straight truck, and then you're getting, $1.80, $2 a mile in driver pay to go do that run. I just don't know that you're seeing a ton of that right now.
Right.
But again, we have another question.
150% of the cost of the truck, 75% of the rate. Those two things are nefarious economics, as you might say.
We have another question coming in from Jessica Corey. When will you be speaking again on partial freight in Sprinter vans?
2 weeks. I think February 1st is the show we're doing with, I won't reveal the guest just yet, but we have someone from the expedite industry that's got a lot of transportation experience. We had a really great call last week, and I think that'll be a great conversation about sprinters and straight trucks and sort of expedite just in time. Such a great industry, right? I mean, it's not as familiar to most folks, but it was really nostalgic to have that call because it's one of those industries where if everything's working well, you're not needed. Your customer doesn't want to use you, right? It's like taking antibiotics. You don't take antibiotics unless you're sick. Right. No one wants to be sick. So you could be working on a project for, Disney on Ice one week, and you could be working on taking rigging out to the Bakken Shale region another. You never really know what you're going to be working on. So it's kind of a fun industry.
Do we have time for one more?
Yeah, let her rip.
We have a question from Rory Saidish. Would love to. Sorry if I butchered your name, Rory. By the way, would love to hear about some insights on the Reefer LTL market for produce-specific freight.
The only Reefer LTL I have experience with is farmer grade, so like high-end refrigerated LTL. I don't, and deep frozen. I don't know if, Dean, what do you?
I don't have a lot of experience other than because of the 150-mile ag haulers exemption. A lot of the loads you put into a refrigerated van are kind of LTL because of all the multiple farm pickups you have to do. That's kind of that's how you get treated when you go out to regional farming communities is multiple pickups. But I think what he's talking about there would be moving a pallet on its own or a few boxes on its own. I don't have any experience with that side of the LTL space. It's all full truckload.
Yeah, honestly, I'm curious how now it's piqued my interest because I mean the FDA, the cargo claims and all that stuff for produce and whatnot, it's pretty stringent. I'd be curious how that would look with a commingled freight situation in the back, like with a common carrier.
Yeah.
It's something we can look into. We can shake some trees to see if we have any.
Yep.
Got to read this one, Ned, because the answer is so simple.
Yes. Hamal Hoover asks, I was waiting for you guys to finish up. What's the best way for a new authority to get good paying loads? Ken?
Join DAT.
Yeah.
It's not just a shill, though. Like, honestly, we have a lot of loads available regardless of your market. The good paying part is going to be something that there are good paying loads on the DAT boards, but knowing what your price is and what price you're willing to accept is a big part of it,
Yep.
Well, the nature of having feasibly all of the loads is that it's a mix of good and bad paying, right? But there's no magical source that only has the good paying. No one would post there.
Right.
I mean, think of the economics at play here, right? I mean, people come, indirectly, shippers go to brokers. Brokers come to our load board to post loads because they're trying to find the most economical service option. When I mean service option, I mean, like, will it get there on the set amount of time I needed to get there safely without getting stolen or destroyed? Right? They want to minimize cost and maximize service. Those are the economics at play. And the network effect is what we offer, right? We have the most carriers, therefore we attract the most loads. So again, I mean, I think it's important to sift out, right? If you want 50,000 pounds of rice coming out of Seattle in burlap sacks is a heck of a lot different than 23,000 pounds of wrapped and palletized spare parts. So like understanding what you're best suited, understanding the lanes you run in, and then building some consistency into what you're searching for and who you're working with, that's a pathway to success that's pretty indisputable, and it's definitely repeatable. Just getting out there and hunting and pecking amongst millions of loads is not going to get you what you're looking for, unless you guys disagree. But I mean, that's not a common strategy that I've seen.
You've also got to really understand your operating costs. That's probably as important as getting the right paying load, because it's the margin between cost and trip revenue that you've got to watch as much as anything.
All right, I think that's it. That's all the questions.
Yep.
Yeah.
I was kind of hoping someone would ask, where do I find out how much to charge? And I'm like, well.
Have we got a tool for you? All right.
Yeah.
Okay.
Dean, do you want to plug where you're going to be this week?
Yeah, on Landline Now tomorrow night, 7 p.m. Eastern, on channel 146, Sirius Road Dog.
Ned, anything in your world?
Nothing that I can talk about right now. I'm sorry.
I'm going to keep pressuring you on that until you can talk about it.
I
recorded a Freight 360 podcast with Nate and Ben. They're over at Freight 360 last week. I don't know if it went out on Friday or if it comes out this Friday or whenever. I'm sure Nate was so thrilled about the Bills winning their playoff game that maybe things got delayed a little, or he got frozen. He was actually going to be at the game, but that was a really great conversation. We went long. We talked about a ton of stuff. Highly recommend checking them out, especially if you're in the brokerage space and you're looking to do any sort of like starting your own business or starting your own agency and kind of navigating all that. They provide what I would consider to be some of the best insight in the industry. And Dean's talked with them before as well, so highly recommend. All right. I don't think I'm missing anything else. We will see you next Tuesday at 10 Eastern. Hopefully I won't be in the basement. And I hope everyone has a great week. And if you're
Yep.
in the snow belt here, I hope you're digging out safely. Bye, everyone.
Yep. Bye-bye.
Bye.